I want to thank the University of Tasmania, of course, for allowing us again to use this facility. It's a splendid facility, and of course the university helps us with publicity as well. Before I introduce our first-class speaker, may I make a couple of brief announcements on behalf of the branch. The branch committee is meeting tomorrow. It's a very small committee. We still want more members, but we have an AGM coming up shortly, so we'll probably be able to recruit a couple of new members then. But at tomorrow morning's meeting, we have a fairly important agenda, and one of the items will be to select the next speaker, and I have a rather exciting prospect, and I hope we can announce the speaker within the next few days. And I'm hoping that the topic that will be covered will be the recent espionage scandal and the predicament for Australia, particularly its dealings with Indonesia. The Launceston launch, because we've never had a meeting in Launceston, will be on the 26th of March. For those of you who didn't hear Dr. Tony Press on the Antarctic, there will be an opportunity for you to hear him there, but we're particularly hoping, of course, that our Launcestonian friends will be able to attend. They've been starved of institute opportunities, indeed since the institute was established here about 50 years ago. Now, I want to also announce that we've been in discussion with His Excellency the Governor, who has agreed to host an annual Government House lecture and reception for institute members and their guests. And this will supersede the traditional patrons' dinner. The example that we're trying to follow is that set by Penny Wensley, the Governor of Queensland, who established the Fernberg Lecture. And of course it's an opportunity to give members of the Institute a special opportunity to visit Government House and to be guests of the Governor for a rather special event. However, I have to say that Tasmania benefited greatly from, in previous years, several years ago, by the opportunity to host a patrons' dinner, and I noticed that Sir Guy Green, who's been a staunch supporter of the Institute over a long period, was always very, very conscientious in attending the patrons' dinner. Thank you on behalf of previous members and current members, Guy, for that. So this is an experiment, but we hope that it will become a tradition. And the Government House, as Sir Guy knows only too well, Government House Ballroom houses many more than Government House in Brisbane, because in Brisbane the Governor requires the Institute to restrict the guest list to 80, whereas Governor Underwood has assured us that 200 can be seated in the ballroom, but I'm not assuming that we will be inviting 200 for our first Government House lecture. But I'm hoping it'll be a distinguished speaker and a popular speaker, and that there will be a very, very positive support from our membership to this inaugural event. And we're in discussion with Government House on the dates and other terms and conditions. The AIIA website will shortly be replaced. It's a very exciting new website, but it will affect the state branches because we all have to be offshoots of the national website. And considerable expense has gone in, far more than I ever would have allowed or authorised or recommended, has gone into designing this new website. But in addition to the website, in addition to the new format, there will be a section called Australian Outlook. Now, I was puzzled by hearing about this because I used to edit Australian Outlook 40 years ago. And it's now the Australian Journal of International Affairs. But they want to call this section of discussion Australian Outlook. And there will be there'll be short commentaries on current issues, changed every couple of weeks. There'll be brief book reviews, alerting people to exciting new publications. There'll be a section of political commentary by younger members. They didn't know what to call that. In fact, there's been more discussion about what to call it than about anything else, it seems to me. But there'll be other features in this new exciting website, so keep a lookout for it. They're in the experimental stage at the moment. I don't think it's been formally launched, but within the next week or so it should be. Now, there are copies of the latest policy commentary produced by the Institute on the table for members to take. The title of the November one is Japan's New Trajectory. These are published every 3 or 4 months, and some of them are very good. In fact, all of them are very good, of course. Now, that's enough from me, because it's delaying my introduction of our speaker, who's an old friend and, of course, a former colleague from the School of Government. What used to be the School of Government, which doesn't exist anymore, but it's all by a new name. We're constantly changing names and restructuring, as you know, at the university. But Steve Bell, who, after a very successful stint at the University of Tasmania, went up to the University of Queensland, has become a very, very much publicised and much published political economist, international political economist. And political economists are still fairly rare species among political scientists at any rate, although there are more of them than when I was a youngster in academia. They were really rare, not just endangered, but very rare species in my time. Now, this means that, of course, Stephen is able to address a much wider audience, and a very different sort of audience than most political scientists are able to address. Despite the fact that we lost him to the University of Queensland, he managed to leave us a very, very valuable legacy in Richard Eggleston. And I think he probably supervised Richard's doctoral thesis, and now Richard is making sure that the flag for international political economy is still proudly flown in Tasmania. Now, there's no doubt that Stephen's publications have been focused on a very wide canvas. There's nothing narrow or petty or insignificant about his titles. He's focused mainly on banks recently, not so much the inner workings of banks, but the way in which banks are governed and the way they interact with the polity, if you like. His most recent work has yet to be published. It's the title of tonight's lecture, and he's just received word that it's to be published by Harvard University Press. Harvard University Press published his last book, which was The Rise of the Bank of China, which he co-authored with a Chinese scholar. And his next book is about the Bank of England. And I was wondering whether he could find a publisher of sufficient prestige after Harvard to guarantee publication of this one. But of course there is always Oxford and Cambridge. Now I think that's probably enough. I don't really know how Stephen will tackle this issue. I think the title is wonderful. The Masters of the Universe, but Slave of the Market, Bankers and the Great Financial Meltdown. Professor Stephen Bell.
Thanks very much, Peter. Now, the challenge tonight is to be able to read my writing. And I'm really not going to talk that much about what Masters of the Universe and Slaves of the Market actually means, because what I'm going to do is trying to give a kind of a general, kind of lay view of the banking crisis that peaked in 2008. So I'm not going to go into kind of technical political science theory and talk about the sort of theories we use to explain all this too much. But what I want to do is kind of outline a series of kind of puzzles that gripped Andy Hindmore and I. We wrote the book together, and we've been working on this for about 4.5 years or something. So we finished this book just before Christmas, and it was great yesterday to get word from Harvard. So this is a kind of an empirical discussion of what's inside the book, basically, and the kind of things that gripped us initially and got us interested in this sort of project. So the banking crisis that peaked in 2008 with the collapse of Lehman Brothers sort of started in 2007. It really sort of took off when Lehman Brothers collapsed in 2008. It was basically big banks in the US and UK and some European countries that loaded up on what we now refer to as toxic assets, and it kind of went bust, in that period. and managed to bring down the kind of most of the entire Western banking system in these major economies. And what you get, and there's lots and lots, there's a stack of books that high now on the banking crisis, and the challenge is, well, what are you going to say that's new? And all along this process of writing this book, we've always been struck by the fact that no one's kind of cottoned onto the kind of initial questions and puzzles that we kind of picked up on. I kept saying to Andy, surely there's somebody who's going to come along and write a book about this sort of stuff. It's so obvious, we would have thought, but no one seems to have done it yet. What you get with books on the banking crisis is what we call a list approach, and it's all those things, which I'll go through briefly, that sort of came together. So it's a list approach. I haven't written it down, but you can also call this, the general kind of view is it's the perfect storm theory of the banking crisis. A whole lot of things came together in a kind of a unique mix and drove the banking crisis. And there's a lot of factors involved. In a way, it was a perfect storm. But this list approach is not a good theory, and it's not a particularly good account of what happened, as I'll try and explain. So one of the key factors, we had a savings glut, which is basically lots and lots of money piling up in China, Japan, the OPEC economies, the saving nations, with really big current account surpluses. And that was basically tons and tons of money in the global economy. And as it turned out, it flowed to the debtor economies, particularly European economies and the United States. So the savings glut, that's lots and lots of money in the international economy wanting to go somewhere. Between 2001 and 2004, Alan Greenspan and the Federal Reserve was running low interest rates, partly because of the dot-com crash, partly because of September 11. So interest rates were down to about 1%, very low for an extended period of time. So the money was cheap, so you could borrow lots of money at a really low interest rate in the United States in particular. Needless to say, that generated a housing boom and a subprime boom, which is to say the nature of the US mortgage market was relatively unregulated. There was lots of shonky operators peddling mortgages to just about anyone that could put a cross on a piece of paper. So you had ninja loans and all that sort of stuff that we kind of know about. And the subprime market was also a kind of an avenue for banks and mortgage houses to, in a sense, to pump up the market. Once the kind of natural market of normal mortgage lending was exhausted or saturated, there was so much, as I'll explain in a minute, there was so much demand for new mortgages to be recycled into the financial system that the subprime market opened up in the United States and was about, I think, something like about $2 trillion, I think, in the end. The banks became involved, and I'll say a lot more about that later, but the banks became involved heavily in this process. And one of the stories of the origins and drivers of the crisis was this notion of, bankers got really greedy and rapacious and so forth. So the greedy banker story. There was a lot of regulation in the US and in other countries in the post-war period coming out of the disasters of the 1930s and the banking crises of the 1930s, which weren't quite the same sort of crisis as this one. And from the 1970s and particularly the 1980s and 1990s, that regulation was wound back. A kind of a neoliberal ideology took hold in Wall Street and Washington and the Federal Reserve. The cheerleader, of course, was Alan Greenspan, the chairman of the Fed, who had quite a dry neoliberal view of the world, i.e. Markets always and everywhere are a great idea and government regulation is highly suspect. That view, with successive administrations, Republican and Democrat administrations, became really strong. So even the Democrats were heavy deregulators. One of the key steps was the abolition of the Glass-Steagall Act out of the 1930s legislation, which put a firewall between investment banking and commercial banking. And commercial banking is the normal high street retail banking. Investment banking is the riskier stuff, or the consulting end of the banking business. That was abolished in 1999. But basically, regulators took the view that bankers were professionals, that markets and market competition was a good thing, that banks would look after shareholder funds and would do the right thing. And there was also, in the 1990s onwards, a lot of work that banks put in place around risk management, and they developed all sorts of new technologies, particularly a big one called value at risk, which was a sort of a gee whiz technology that could value risk exposures in bank portfolios almost in real time, and give senior managers of banks apparently a really good handle on risk. And the bankers argued that, look, we can do this ourselves. You know, of course we want to be sober and we want to stay in business, and you can trust us. So there's a huge amount of trust built up between the banks, i.e. Wall Street, and the regulators and the Federal Reserve and anyone else that mattered in officialdom. The banks also, this is a slightly kind of cynical view, but the banks were well aware that if they went bust and something did go wrong, they would be bailed out by the government. This is the insurance kind of view of the world, moral hazard. Moral hazard basically encourages, or can encourage reckless behaviour. What happened in the 20th century was that banks radically wound down their capital levels, which is the equity, and essentially skin in the game from shareholders, and were funding themselves increasingly through debt, not equity, or deposits. Essentially, that was transferring risk from banks to the state. In the 19th century, banks used to have 40 to 50% equity holdings. The market considered that was about right in the sense of protecting shareholders and a backstop. But through the 20th century, banks argued successfully to wind back capital levels. Banks increasingly took on roles in insuring deposits, and central banks took on the role of lender of last resort. By the time of the crisis, the banks in question in the UK, US and the large European banks were just massive. The three biggest banks in France, about 300% of GDP, French GDP. The largest banks in the UK grew to 500%. Their assets grew to 500% GDP, so they're 5 times bigger than the economy. One bank, Royal Bank of Scotland, was the size of the British GDP. Ditto for a number of large American banks, although the American banks, even though they were huge, Citigroup had a balance sheet of $2 trillion or more by 2007. The American banks weren't as big compared to the economy, because the economy is obviously much larger. Anyway, these banks are just massive. And increasingly there was a view in the markets that if something seriously goes wrong, we'll get bailed out. Now that view, even though it happened in a sense, that came true, that kind of view of the world. Basically, bankers weren't too worried about what was happening. The involvement of the banks in this essentially a financial bonanza occurred through a process called securitisation. So all this down here, from here down, is getting a bit technical, so I'll do my best. Securitisation is a process essentially of turning illiquid financial assets into tradable financial assets. Essentially what happened was that financial innovators and banks and investment banks, and in the end commercial banks, were trading mortgages. So instead of the normal model of boring banking or traditional banking is banks basically take in deposits, lend the money out, and make a profit on the interest spread. or the 363 model of banking. You know, you take in money at 3%, lend it out at 6%, and you can be at the golf course by 3 p.m. You know? Like, really boring banking, and banks have sat on mortgages for 30 years, and that was essentially banking business. That's traditional banking, or boring banking. In the financial heartlands of the US and UK, what happened was that banks increasingly started to buy and sell mortgages for a profit. And securitisation is that process. It's simply hoovering up as many mortgages out of the housing market as possible, and building those mortgages into tradable financial assets. This thing here, RMBS, residential mortgage-backed securities. So that's basically a security based on perhaps maybe 10,000 or even 100,000 mortgages packaged into a security. The best image of what I'm talking about is this Rubik's Cube kind of model, where you're just building tons and tons of mortgages into a structured product that you sell. These things can take 6 months to build. You know, they used to refer to RMBS factories. The investment banks were in this business big time. And what you're doing is building a security. They had all sorts of esoteric names, and they had, you know, very thick documentation describing what they did and the various sorts of composition of the mortgages and so forth. This thing here, CDOs, is essentially a security, and what the real innovation that occurred through the 90s and 2000s was to actually build these securities by adding a whole lot of quite rubbish mortgages down the bottom in the so-called junior tranche, slightly better quality mortgages in the middle, and at the top you've got the super senior tranches. So what you were doing is building this sort of Rubik's Cube kind of structured product made up of all sorts of different mortgages of different sorts of quality. So down the bottom you've had a whole lot of kind of subprime rubbish. Up the top you might get mortgages taken out by, you know, brain surgeons or something. They were going to pay the money back. And the idea was to sell these securities, and you could buy different bits of them. So they were tranched. So a CDO, a collateralised debt obligation, is just one of these things. And the tranching is the idea when you're building these things. And the idea was that if you bought a top or super senior tranche at the top, you were almost guaranteed payment of a stream of income coming from those mortgagees and the payments of the mortgages on a monthly basis or what have you. If you bought these ones down the bottom, you get a better return, a high yield, but there was greater risk because they were coming out of subprime, essentially. But the view was that mortgages were coming out of the housing market. The US housing market had never declined nationwide since the 1930s. There'd been regional declines, but the view was that some bits go up, some bits go down. The housing market in the US was considered rock solid right up till the end of 2006 when things started to happen. And the banks thought, well, why don't we just buy these? Why don't we buy these super seniors? Because we can get a better interest rate on that than we can through traditional lending. The margins in normal banking were going down. There was a lot more competition. It was just harder to make money out of traditional boring banking. Banks were looking for new ways to make profits, and this was the bonanza that took off in the 2000s, essentially. Originate and distribute banking was the securitisation process and the market, essentially. So the idea was that banks would hoover up lots and lots of mortgages, build these complex residential mortgage-backed securities or other kinds of securities based on, you know, car loans, student loans, anything. Any kind of debt could be built into these structures. And the idea was you'd originate these mortgages, package them up into CDOs, and then distribute them to financial markets worldwide. So the Icelandic banks, for instance, loaded up on US CDOs. Pension funds. The Gosford City Council in New South Wales lost $50 million on these investments. You know, these products were distributed worldwide. This is one of the reasons why the banking crisis became so serious, because it was a global crisis, or at least it affected a whole range of countries because of the essentially globalisation of the RMBS market. Because the banks didn't fully distribute, the view was, oh, we build these things, we package them up, we sell them, we market them, and we flog them internationally. This is the distribute bit. But what happened was that the banks actually, in the end, were starting to load up on these assets too, particularly the super senior tranches at the top of the structure. And that was considered really safe because the ratings agencies, Moody's and Standard & Poor's, were giving these products AAA ratings. No one has yet written a really good book on the ratings agencies, but somebody should. They got away with murder. But they were dishing out AAA ratings to these structured products. They didn't. The agencies, Moody's and Standard & Poor's and Fitch, the big three, didn't really understand this stuff that well. And no one in the banks, the ratings agencies or anywhere else was actually looking through these structured products to the underlying mortgages and the quality of these mortgages and asking serious questions about quality. By 2006, there was about 65,000 structured products in the market globally that had AAA ratings based on this stuff. And only in the US economy, there were only 6 companies with a AAA credit rating on their debt. IBM, Johnson & Johnson and a couple of others. So only 6 companies got AAA, 65,000 CDOs or esoteric financial products got AAA. Part of it was that the banks were paying the ratings agencies. By 2006, as the crisis was starting to generate, the ratings agencies were making about half of their profits out of doing this business. That was big business. They knew if they weren't dishing out AAA ratings that banks would go elsewhere for business. That was explicit in the marketplace, etc., etc. So that meant that all sorts of investors could buy these products because you needed, by law in many cases, for pension funds, etc., you needed a AAA rating to actually be allowed to hold these assets. So pension funds loaded up on them as well. Local governments and all sorts of things. And the other innovation in financial markets is that the CDS market took off. So CDS is credit default swaps. It's a form of bilateral trade, not through a clearinghouse or an exchange, over-the-counter, OTC trading. Basically, it's a bet. So AIG, the giant American insurance company, and another bunch of insurance companies said, we'll insure these CDOs and other structured products. So it's a bet, you know. We'll take on the risk. So the banks, in most cases, took out CDS contracts on their CDOs and other structured products and said, this is insured. What can go wrong? So if you put all these together, particularly these ones down here, and including slack regulation, because slack regulation said to banks, oh, well, we've convinced governments and regulators and the Federal Reserve and the Bank of England and everyone else, this stuff looks good. They're all saying go for it. It must be good. So that was reassuring. We've got, if it really goes pear-shaped, we'll get bailed out. Securitisation is the new financial boom. This is financial innovation. This is the banks taking on PhDs in physics and maths and so forth, and risk managers, and we've got the brains to make this stuff work. This is the new millennia. You know, this is the new banking. It was all this mantra. So there's a lot of groupthink going on. So this is great. This is all about, you know, we've reinvented banking. This is a banking revolution. We've seen nothing like this. This is the masters of the universe thing in the title of the book, partly. We've distributed the risk around the system, so we're not holding tons of risk ourselves. That was wrong, actually, but that was one of the prevailing views. We've got AAA rating, and we've got, in the end, we've got CDS insurance. What can go wrong? You know? What can go wrong? So the view from the bankers was that this is safe and it's money for gravy. Nothing can go wrong. That they were adamant. If you talk to bankers in the run-up, and we've done this with interviews extensively across the 4 countries we're studying, the prevailing view amongst bankers and financiers was that this is money for gravy. This is no one, for some reason, no one ever thought of this before, but now we've got it. We're making tons of money. It's riskless. What can go wrong? And there's another view coming out of the banks. That's kind of probably a prevailing view, but there was another view that's also detectable in the work we've done, which is to say, senior managers and the CEOs of major banks, Lehman Brothers, Bear Stearns, Citigroup, Merrill Lynch, all the big American banks, for instance, the view was there that this business was actually a very small part, and Chuck Prince, CEO of Citigroup, made this very clear in one of the big congressional inquiries following the crisis in 2010. And there's a long quote in the book which is extremely illustrative of this view. He said, look, we had a balance sheet of over $2 trillion at Citigroup. He said, basically, this business on the bank's balance sheet was about 30 or maybe 40 billion. He said, that's chicken feed, basically. It's too small to worry about. He said to the inquiry, he said, look, if somebody had to come along, one of my senior managers had to come along and said, Chuck, we've got a problem with these CEOs, you know. They can go up and smoke. You know, there's a worry. And Prince says, he said, if I had been told that in 2005, he said, I would have shrugged myself. You know, it would have been meaningless information. He would have said, well, wait a minute, we've got AAA, we've got CDS, we've got Alan Greenspan saying go for it, everyone else is doing it. What's the problem? And Prince ended up by saying, he said, if I had to run around the bank saying, we've got to sell this stuff, he said, they would have thought I was a lunatic. You know? So a lot of the banks, when things went pear-shaped, a lot of the banks, and particularly the very senior managers, actually didn't know much about this stuff. The board of Merrill Lynch, when the bank was going bust, had to get a tutorial on what CDOs were. I've interviewed the chairman of Westpac in Australia, who actually lost $500 billion here on CDOs, and he said that business wasn't reported to the board. I said, why not? He said, well, it was small on the balance sheet. It is. That's $500 billion even for Westpac isn't big. And he said we had, you know, because it had AAA ratings and CDS contracts based on real, you know, the whole mindset. He said that wasn't reported to the board. It wasn't considered worthwhile. And that kind of view of what was going on was very widespread. So it was either we know all about it and we've analysed it and we know it's safe for 10,000 reasons I've just been through, or didn't even know about it. It was down there in the engine room, and I don't go down there, you know. And all the traders and the young kind of punks down there were trading and making all this, you know, money and running around. But it was just esoteric, and we didn't care about it because it was so small on the balance sheet. So who cares? So that mindset is actually really important. All this stuff came together to convince bankers one way or another what was, you know, happening. It was all safe. Now, that's the kind of list approach, and out of that you'll get the perfect storm theory, and the prevailing view is that this was all about toxic assets based on subprime mortgages that lost value in 2007 when the US housing market collapsed, finally, because it was a bubble. It took all these mortgages and subprime stuff and all the assets and structures that were built on that stuff. It was all, in the end, it was all built on sand, and it just collapsed. So this is the story about toxic assets, and it was basically subprime CDOs and all that stuff that took down the banks. Now, that's what most of the books on the crisis will tell you, and that's all fine. But arguably, that sort of analysis doesn't go far enough. And as soon as I remember hearing about this, you know, when it was kind of unfolding in 2007 onwards, and I remember thinking, and just being really struck by the fact that this kind of account doesn't tell you, for instance, why Lehman Brothers went broke and why within the same national banking system and all the institutional and market pressures on bankers to behave and go, you know, follow the herd, essentially. Why didn't Wells Fargo do this, for instance? Why did Wells Fargo maintain its presence in traditional banking and not follow the herd and not get sucked into the bonanza? Why did JP Morgan get out from 2005 through 2006. And why finally did Goldman Sachs get out in December 2006 when everyone else was having a party? See? And this sort of that sort of list approach assumes that we've got all these factors. Bankers were kind of, as we say in the book, slaves of the market, following the herd willy-nilly. It's all safe, it's all fine, makes tons of money. In the US, 3 major banks didn't become terribly involved, or if they did, they got out and got to the exits first, particularly Goldman Sachs at the last minute. And they ended up shorting the market in 2007. In the UK, HSBC, particularly in their UK and global operations, were cautious and didn't become involved. Lloyds as well. So a couple of major British banks didn't get involved either. And that kind of, why didn't they go for it and follow the herd was to us a really intriguing question. And the answer basically, it's quite a simple kind of answer. It basically boils down to ideas. The bankers that ran those banks were sceptical of these sorts of market shenanigans and could look through the frenzied Bonanza and the whole boom groupthink mentality and see the thing for what it was and ask serious questions about the veracity of, well, hang on, these subprime mortgages aren't that good and we're building this huge kind of boom bubble edifice on top of all this stuff. What's this mean? And they were seriously questioning all sorts of risk analysis methodologies and a whole bunch of other things. And as it turns out, we've studied, in the book, we studied we've got 25 banks across the US, UK, Australia and Canada, and we studied each bank inside out. What happens is that these banks, Wells Fargo, JP Morgan, for instance, and Goldman Sachs, are run by CEOs that are not like the other CEOs. They're actually completely connected with the business. They understand what's going on the trading floors down below. They understand risk analysis methodologies backwards. They're all over their banks, and the banks themselves are unlike the banks that went bust in the sense that the banks are almost like an academic department where you have endless debates about stuff and there's information flows and all sorts of discussion particularly about risk management and what's on the balance sheet and how it's performing. The banks that crashed were almost invariably run by imperious CEOs who ended up looking like, well, in fact, probably were megalomaniacs. The bank hierarchy was extremely steep. Information flows were very poor. When Bear Stearns and Merrill were going broke, their CEOs respectively went to a 10-day bridge tournament somewhere else, and the CEO of Merrill Lynch started playing golf by himself and was usually found on the golf course as the bank was collapsing, so that they were completely detached in the end from the bank in a physical sense. The CEO of Merrill Lynch, when he was finally jettisoned by the bank, took out a package of $161 million. He took that home, probably played more golf with it. But anyway, if you look in terms of the banks, the ideas of the leadership and the organisational structures, and obviously they're linked, they're quite different. In fact, they're starkly different systems. The same with Lloyds and HSBC in the UK, etc. So in our jargon, we're calling this within-system variation because in the sort of analysis we do in political science, there's a lot of theory about institutional arrangements constrain actors a great deal. We're all part of groupthink and institutional constraints, and it's very interesting to get the minority of banks and CEOs and senior leaders who are not following the herd, who are thinking independently and running quite different types of banks. So the within-system variation was one of the things that first struck us when the question was, well, why didn't Wells Fargo go down? What was going on there? So we try and answer that question at great length in the book. We've got this enormous chapter on the US banking system, which is basically analysing what bankers thought and how they operated bank by bank. So that's one. Two, another puzzle. Why did the banks in the US and UK generally collapse and some major European banks like Deutsche Bank, etc., the German and Dutch banks in particular. And why didn't the Australian and Canadian banks go down? That's an interesting one. And if you think about it, the Canadian banking system's on the doorstep of the US banking system. And you think of banks and globalisation of finance, it's all quite connected in some ways. So what's going on with these national variations? Well, the short answer basically is that in these systems, you've got regulation that really monitors and controls banking competition. In Australia, we've got the Four Pillars policy. Four Pillars policy was designed to increase competition so that the big four banks couldn't merge with each other, so we ended up staying with four banks rather than one or two. But in fact, it actually stymies competition because the big four banks aren't worried about being taken over by their rivals. This is a really important issue. But the list approach to all these factors doesn't talk about bank competition and the competition and levels of competition in banking markets. But if you do this sort of comparative analysis, bank competition in national banking system is really important. Arguably, it's one of the most important factors driving this whole story on either side. In the US and UK, since the 1970s, deregulation came with policies to increase competition in the sector. The rise of kind of equity share market capitalism and the tyranny of short-term equity placements kind of tyrannises corporations and senior management, i.e. if you're not performing, if you're not maximising shareholder value in return, there's something seriously wrong. So Wall Street's peppered with stories of CEOs that got booted out because they weren't performing enough, and through the boom you got these ridiculous rates of return on investment, ROE. So Goldman Sachs was always the market leader, but they were getting sometimes 25% return on equity per annum, and that became the benchmark. See? So investors, which CEOs and senior managers operate in a fishbowl. They've got the media, they've got the whole investment analysis community, they've got the share markets, the threat of hostile takeover. So that they can barely sleep at night. They're constantly under this immense pressure to beat the market leaders. And beating Goldman's became the mantra on Wall Street. If you were not getting 25%, which none of them did, Lehman's and Bear Stearns, for instance, the smaller and big investment banks were getting 15, maybe 16%, which is good. But it's not what the whiz kids in Goldman's could do. It was always, oh, Goldman, So you didn't want to be around the CEO when the Goldman's, when the Goldman's, numbers were revealed in the media. So in this system, there was intense pressure to make tons of money, and if you weren't making tons of money, you were booted out and replaced by someone who was crazy enough and had this euphoric view of the markets that was going to come in, and it happened all the time. Through the 2000s, more conservative CEOs were sacked and replaced by buccaneers and corporate kind of raiders and Vikings or whatever else their metaphors are. In Australia and Canada, by contrast, governments took a very dim view of excessive banking competition and enshrined that in legislation which protected the major banks from hostile takeovers and said to them, basically, the banks in Australia do want to make money, obviously, and profits, but the intensity of the pressure is not the same. The other difference is that in the UK and US, as I said before, you weren't making a lot of money out of traditional banking. And the normal returns from investment banking practice, mergers and acquisitions and corporate advice, didn't look too good compared to the bonanza in CDOs and the whole securitisation game. So that was the way to make money in those markets, but in the Australian, Canadian markets, the Australian banks were making world-beating profits by boring banking, because the mortgage sector and the commercial lending sector in Australia was strong. And we didn't have, so far, we haven't had a housing bubble. The Reserve Bank's been on the ball in 2003-04 and trying to cool off what might have been a boom and a credit bubble. We've got full recourse mortgages, so the banks can chase mortgagees. It restrains kind of reckless lending and reckless borrowing, etc. So there's a whole bunch of legal regulatory arrangements in Canada and Australia are quite different to the US and UK that explain these quite different outcomes and explain why the Australian-Canadian banks broadly remain relatively conservative despite the fact that, as I said before, Westpac lost $500 billion and NAB lost about $1 billion in this game. I interviewed the senior manager in charge of investment banking at Westpac for this project, and it was an extraordinary interview. He said, "Oh, you know, at NAB Capital he ran. He said we wanted to be, we were the biggest investment banking arm in the Australian banking system. We wanted to get bigger. We wanted to become global players." And he said, frankly, we were trying to buy as much of this stuff as possible. And then he said, if the crisis hadn't have happened in 2007, we probably could have brought the bank down. And he said that in the interview, and I sent it, you know, as I do with the protocol. I sent it back. I said, "This is what you said. This is how it's appearing in the text of this book. You know, they've got rights of veto or editing." And he looked at it and said, "Yeah, that's okay." So I've got all the email trails of that correspondence in my filing cabinet locked away in case I need it, but that's what he said. So anyway, that's kind of an aberration. It's quite possible that if senior management had got wind of, you know, maybe in a year or two, wind of what was going on, there might have been more serious questions asked. Although from the Westpac experience, the board, for instance, didn't even know about this stuff. So in some ways, poorly run banks are disarticulated organisations with all sorts of bits going on that no one's actually looking at the whole picture. So that's 2. Down here, 3. Another interesting puzzle. The IMF calculated that the losses in the securitisation CDO Bonanza by the end of 2008, when the crisis had sort of peaked, the losses on the balance sheet of banks was in the order of $500 billion across the US, you know, across the system, US and UK banks, etc. That sounds like a lot of money. In fact, it's not. Citigroup, for instance, and nowadays JP Morgan have both got balance sheets of well over $2 trillion. So it's only a quarter of the balance sheet of one bank. Daily movements in the US stock market can move by more than 500 billion in a day. There's all sorts of other interesting comparisons, but 500 billion is not a lot of money in the system. The global derivatives markets these days are running at close to $70 trillion per annum in turnover. So 500 billion is small beer. And the puzzle then is, well, why did these losses on the balance sheet of banks in these weird kind of esoteric areas on their balance sheets bring down the entire banking system in the US, UK and major European banks? And the answer is that the banking crisis is not really about toxic assets in the sense that toxic assets simply triggered something much bigger. And the metaphor is that, in a sense, the masters of the universe, because they created the system and they got governments on side to deregulate and allow them to do what they wanted to do. You know, they created the system. That's masters of the universe in that sense. That's really important. They're also slaves of the market because they got sucked into this stuff and believed in it and got pushed along by competitive pressures, etc. So they're also slaves. But they actually built a system they had no idea about in the end. And it was a set of, in our jargon, a set of structures that were surrounding them that were quite invisible even at the beginning of 2007, that gradually became much more apparent by 2008. And the problem was, and no one had kind of cottoned onto this at the time, but the problem was that the banks, to make money out of this game, out of the securitisation and CDO trade, you didn't make a lot of money. The margins were actually quite small. The way to make profit was huge volumes of trade. The only way to get huge volumes of trade out of the system was to leverage up the balance sheet. Leverage is debt. So the banks, you know, forget about consumer deposits, that's small beer. It's not nearly enough money to ramp up the scale of the operations required to boost the balance sheet. So The balance sheets of the top 10 global banks in the 2000s doubled in size. It's about 5 years, doubled in size. It was debt. So the banks were taking on massive amounts of debt from the wholesale funding markets and a whole bunch of other wholesale funding markets. A lot of it sourced from China or other places. So in the end, you had extreme levels of leverage, which is to say debt to equity. So most of the banks were running leverage at 30 or 40 to 1. The giant mortgage houses in America, Fannie Mae and Freddie Mac, were leveraged to 70 to 1. Which is to say, if you're leveraged at 40 to 1, a slight downturn in asset prices can make you bankrupt really quickly. And what happened was, because of the complexity of these products, no one could really fathom what was in them. The trading market was quite opaque. It wasn't a very transparent market. So when the housing bubble collapsed in late 2006 through 2007 in the States, investors and other banks started looking at each other saying, well, how much have you got on your balance sheet and what is it? In the end, you couldn't sell CDOs. The market disappeared. You couldn't get a buyer. The complexity of bank balance sheets, the opacity of the market, meant that in the end you couldn't read the market, and investors and banks simply became terrified of each other's balance sheets. And the ultimate problem was that they refused to lend money to each other, which is essential in the banking system to keep it liquid. So in the end, what brought down the banks was not that they had $30 billion of assets that weren't performing very well on their balance sheets. It was the fact that their balance sheets were relatively opaque, and the banks essentially refused to lend to each other. So what you ended up getting was a global credit crunch and a global run on the banks through the wholesale markets. This is not a normal bank run where depositors rush down the street and try and get their money out. It was simply a bank run from the wholesale market saying, we're not lending you money anymore. We don't know what you've got on your assets and your balance sheet, and we can't understand it. Everyone's rushing for the doors and we're not lending. That was the global credit crunch. That's why the banks went bust in the end. So that's, in the jargon, that's called systemic risk. And it's a systemic functional characteristic of the financial markets that the masters of the universe created, that they did not understand. And when the roof fell in, they certainly couldn't control. So the masters of the universe really did become slaves of the market at that point. When the roof was falling in, everyone was running for the exits. The wholesale markets froze, and then a whole series of banks, domino-like, went bust. And that was through Lehman's was the real trigger for that panic, when the US government didn't bail out a bank. And the market panicked, and the rest is history. We're still living with the very sluggish rates of credit. Banks, since the crisis, have been trying to rebuild their balance sheets, not lend. And the financial crisis, particularly in Europe, has morphed into the sovereign debt crisis in the European economies. So it's still rolling on. We discuss, just to round off, we discuss what to do about all this, and there's a long chapter at the end of the book on bank reform. And the reforms that have been put in place are quite strong and positive in some ways. Bank capital levels have been escalated. There's attempts to separate investment and commercial banking through new firewalls, etc. All looks, this regulation would have been unthinkable prior to the crisis. The problem, which is a big problem, is that the authorities and governments in the US and UK, the heartlands of global finance, still believe in what we call big finance. This is gigantic financial systems dwarfing the size of the economy or whatever. They still believe in financial innovation, and if that's the case, financial innovation and the new gee-whiz products, whenever that occurs, will inevitably outstrip the capacity to regulate them. We will have another financial crisis because the system fundamentally hasn't been reformed. That's the depressing note I'll end on.
Well, thank you very much indeed. We do have time for questions. In fact,
stuff and futures and this, that and the other. But something that in the political realm that has my ears vibrating loudly is the comments from Joe Hockey and... am I not speaking loudly enough? Okay.
I can hear you.
Ah, okay. I'm hearing entrepreneurship and risk takers and this sort of stuff getting mentioned an awful lot. And it's starting to worry me because I think politically our new government is into the risk area and vaunting it, lauding it, and that worries me. What are your comments on that?
I'm not too worried about that because the Australian banking market actually came through the crisis really well. The banks had their own meltdown in the early 90s. There's still a conservative culture in the banks. There was a big battle in the 90s between the investment bankers and the commercial bankers, and broadly the commercial bankers won, which was good. The regulator, the Reserve Bank formerly and now APRA, are pretty good regulators, even though APRA wasn't looking at this stuff closely. We've got the 4 Pillars policy, which is really important to limit bank competition. There was a bit of adventurism with 2 of our banks. The Commonwealth Bank and Westpac couldn't believe what was going on in the US market as early as 2005, and were doing serious analysis of the products and the markets and saying, no way. We've got lots of interview material to back that up. And we've now learnt from the 2008 crisis. So as far as the banking system goes, I'm fairly sanguine. The only risk really is, we could be sitting on a bit of a property correction. I'm not sure if it's a bubble. And the Australian banks do rely significantly on wholesale funding sourced from international markets. And when the crisis hit in Australia, one of the first things the federal government did, to its credit, was to come in and guarantee wholesale borrowing for the banks, the big 4 banks in particular, which preserved their capacity to operate, and it was a good move. And that's not hard to do. The government just put its credit rating on the line and said, we'll back it, we'll back that debt. So the Australian Canadian banks are ranked as the best or safest in the world, and the Australian banks are ranked about 3rd. American banks in 2009 or 10 were ranked about 140 something, and I think the Congo was some other country was higher,
But Steve, the fact, just going on from that, the query which relates to some extent to the question raised, given that the Canadians and Australians share a political culture, they're very, very similar, it does seem to suggest that there's more to it than simply the competition, the 4 Pillars policy, to explain why they were exempt. Are there inbuilt sort of ideological restraints there to some extent?
I think Australian Canadian bankers hypothetically could have gone crazy too. But they had their own... The banking crisis of the early 90s was pretty severe in Australia, and Canada had one in the 80s. And it was a really interesting question for us, how long does corporate memory last? And that's quite a complex issue, actually. It's a really complex issue.
Yeah.
We were kind of, in the end, persuaded that there are enough senior people still around that it did make a lasting impact on the culture, and particularly in the 90s, a lot of investment bankers were kind of booted out, and commercial bankers. So in Australia and Canada, we don't have an investment banking culture. That's actually very important. And the other factors are, is that APRA wasn't, it was a pretty tough regulator. The critical one, we think, is competition, levels of competition, and the other critical one is you can make lots of money in Australia out of boring banking, and you didn't have to go... And we've got quotes from bankers saying, look, we looked at the margins, we looked at this and that, this simply wasn't worth our while, getting into this stuff. We didn't need to. And the story, that story is replicated almost perfectly on Canada.
Another question? Yes.
That is, just want to comment. Firstly,
Firstly, what was interesting, I think, the same comments apply to New Zealand as Australia. It was very badly burnt, and of course New Zealand banks are owned out of Australia anyway. And the big crashes occurred with the finance companies, which people lost tons of dough in. So that's a comment. A question. I'm watching Alan Joyce's behaviour. Have you got comments on that? Because he's expecting to be bailed out by the government. Qantas is looking pretty shaky. And interestingly, Air New Zealand's very much on its feet, and the CEO of that is now a CEO of an Australian bank. Or
Was that a question, or?
the last comment, I'm interested in comments on Alan Joyce's behaviour.
Well, Qantas is a pretty difficult company to run in all sorts of dire straits and international aviation markets. They will ask for money and they might get it. But I'd rather talk about banking at the moment.
One distinction between Australia and the United States you referred to, that in Australia lenders have full recourse and take a remedy against the borrower. You seem to suggest that that's not a very significant distinction. I must say, when I discovered that US mortgages don't create debts, which is really pretty odd, I would have thought that it would have made quite a bit of difference. But you don't think it does account for the difference?
No, it does, in the sense that in Australia, with the legal arrangements, you wouldn't have got a subprime sector of anything like the size you got in the United States. Non-performing loans on the bank's balance sheets in Australia are about 1%, if that. Non-performing, essentially subprime loans on US banks are about 13% of the balance sheet, so it's quite a big chunk of activity. And yes, there's a whole range of reasons why the subprime market took off. It was heavily pumped by the banks and the large mortgage companies for the business of generating mortgages at almost any kind of cost to sell on to the mortgage factories on Wall Street, and the whole thing was disarticulated. So there was no connection between the quality of the mortgage and who was going to. It was a hot potato. It was just simply passed on the chain. So no one had any kind of skin in the game. So there was a massive incentive to write shoddy mortgages and sell them on to somebody else and go back for more fee income based on writing mortgages. So the market was heavily distorted, and there was no recourse back to mortgagees if things went wrong. And it is the case that in a number of areas in the United States it was quite rational to buy a house, pay the mortgage, which turned out to be cheaper than the rent. Yep. So after 2 years, and a lot of these initial mortgages, the subprimes were teaser loans, so they reset after a couple of years to a normal higher rate. And it was when they reset that people would walk. And they were called tinkle mortgages. So you just leave the keys, outside the bank or whatever and walk off. And the banks, might have thought, we can go and liquidate the assets. But when they actually looked at the assets, what you had was whole streets full of empty houses that had been vandalised. In some cases, the tenants had actually stripped the house, windows, copper pipes, anything. So the assets were actually rapidly falling in value. So it was a different mortgage market. But if it hadn't been subprime, it would have been some other form of debt that would have been recycled through this essentially kind of industrial process to build securities that could be traded. And even, as I'm saying, even that disaster was a small part of the final problem. The final problem really was the collapse of the wholesale funding markets and the leverage that the banks were running in this desperate search to make mega profits and to try and beat Goldman Sachs or any other market leader that was there.
Yes, sir.
What difference do you attribute in the outcome between Australia and the US that if you sign up for a mortgage here, you're stuck with the sum of the mortgage, whereas my understanding of the American system is if the current value of the property fell below what you mortgaged for, you could just pack up and walk out and have no ongoing obligation. That must surely have made a major difference.
That's what we were just talking about, in the sense of Australia's got full recourse mortgages and the Americans can walk away. So that made a big difference in pumping up the subprime market. The politics of the subprime markets itself is interesting because Fannie Mae and Freddie Mac were heavily involved in this market, and there was a lot of politics around this market is really important because this is the way in which previously excluded Americans can have a stake in the American dream and own property. And it was very easy for Freddie and Fannie to bat off criticism on that basis. This is almost un-American.
Yes, this lady.
I've probably got a big enough voice. I was going to say, when you were describing this, it looked to me like a great Ponzi scheme, and the failure of Lehman's looked like a Madoff in the whole area. Is that a fair enough comment? It was sort of like you looked at Lehman's and it failed and all the other things cascaded around it.
It's easy now to look back and say, why didn't they see this coming? And anyone that studied the history of financial crises, and there's been heaps of them, and in economic history, for instance, there's some really good books and studies and theorists that describe why, kind of broadly the contours of financial crises. They have a lot of similar characteristics. So in some ways, an informed observer would have said, here we go again, right? But partly today it's easy to say that because hindsight's wonderful. But what's really interesting, I think, is at the time, and this is what we do really detailed analysis of what bankers were thinking in the run-up to the crisis in two huge chapters, one on the American system, one on the UK system, based essentially on verbatim commentary from bankers themselves and a lot of interviews we did. And if you try to put yourself back in that mindset at the time, you can understand in a way why so many bankers and so many analysts did get carried away and did think this was a new financial system. And there was a lot of words and a lot of rhetoric and jargon to describe the new system. And it was obviously had a lot of groupthink going on. But there was a view that we've really cracked it, and this is a new financial nirvana. And how on earth could this go wrong? And even if it did, we've got governments, we've got the rating agencies all saying it's wonderful. We've got our high-powered physics PhDs with their risk analysis tools running along every day, saying, "Yep, go for it." We've got CDS. Everything's insured through CDS. Credit default swaps, or at worst, the government will come and bail us out, which happened. So what can go wrong? Why not join the party? The commentary from inside Wells Fargo and JP Morgan and even Goldman was that when they started to exit the market, it was extremely difficult to do mentally to leave the party. And Wells Fargo and JP Morgan were being hammered by the financial markets and analysts saying, "What the hell are you doing?" Now, it's debatable whether they would have been able to continue to do that if the crisis hadn't have happened in 2007, because they were being hammered. Wells Fargo kind of survived because it had a really committed management to boring banking and was very sceptical of the boom. They had a deep presence in strong mortgage lending in good markets, and they had Warren Buffett as a major institutional investor that always wanted them to take the long term. And they had their own rhetoric and culture saying, we're not into the cycles and the swings, we're here for the long term. and we're here to serve customers, blah, blah. It sounds, and one of the CEOs, all these bankers got grilled by the Financial Crisis Inquiry Commission, the FCIC in America, which is a big congressional inquiry in 2010-11. And the CEO of Wells said, who, you know, somewhat backcountry kind of guy, I guess, but he said, we're a meat and potatoes bank, you know, and he said, if you want tuna and fennel, go somewhere else. We're not like that. See, they had their own corporate identity, which was really important. And JP Morgan under Jamie Dimon did too. And Jamie Dimon in 2005 was running around the bank saying, I've got a bad feeling. I'm getting cold feet. This stuff can go up in smoke. And it was very hard to do that. Even Goldman Sachs got in December 2006 and started selling heavily and then shorting the market. There was a lot of angst inside the senior management saying, this is bloody crazy, but we're going to do it. But is this right or wrong? No one really knew. So even with the ones that bailed out, they didn't really know either. But they took a hunch, luckily for them. But the rest of the banking community on both sides of the Atlantic was absolutely of a mindset that this is safe.
Is that...
At the time.
So really, the group that you're talking about is just the opposite of the Australian and Canadian, because they'd already been effectively warned off by previous disasters. So the people in Australian banking now are of a certain age. Well, they're getting older, aren't they? I mean, so then... But what about their memory is expanding outwards. So is there going to be enough young people coming through who are going to say, hold on a minute, I remember something from the past?
Well, they're appointing the next generation of bankers too.
So we're protecting them that way, are we?
I'm not going to stand up and make pledges about what's going to happen to the Australian banking system, but on what we know at the moment, we came through the crisis really well. It's good, thank goodness. Imagine if we had had a banking crisis too. We're heading, as Garno has recently argued, we're heading down. And it would have been a lot worse in this country without a sound banking system and a mortgage market that hasn't collapsed. So.
Couple more. Time for a couple more, yes. And then
You mentioned before about innovative banking and the innovative banking always being in front of regulation in some kind of way to try and control that. If regulation was to be done properly, like you suggested, to try and curb that sort of thing from causing this problem as opposed to just good innovative banking, what would that sort of regulation, what could it possibly look like? And is that something Australia could do unilaterally, or does it need to have a global industry commitment?
Okay. Look, if you allow the gigantic financial systems of the US and UK to continue as they are, which right now, what we've got is bankers who essentially have come through the crisis and been supported by the state. So you've got Citigroup and JP Morgan, etc., who are now much bigger than they were before the crisis, because as usual, you consolidate in a crisis and the winners take all, in a sense, and clean up the little guys. They've been bailed out. They know they've got bailed out. There's no, moral hazard's gone up through the roof as a problem in the system. The banks are much bigger. The financial system, even though this area of investment banking and the securitisation markets have collapsed, even JP Morgan in the London whale incident lost $6 billion on some trader going crazy with some weird, wonderful new product, which was really embarrassing for the bank. But it's an indicator that, and recently we've had major scandals on remuneration. We've got a number of international banks involved in money laundering, all sorts of things. So they haven't changed their spots fundamentally. They've just gone into a corner for a while. The system's, in a sense, bigger, and arguably, we argue, politically more powerful than it was, despite the crisis. And you've got this massive competitive pressure on bottom line returns. Competition is a really big problem, and the reform mantras out of the US and UK are arguing, we need to have a highly competitive system. They haven't got it. This is a really important message of our book. Competition is not a good idea. The depression legislation in the states out of the 1930s talked about ruinous levels of competition. That message has gotten lost somehow. It's still the case that the authorities still think competition is good. It's not good. The problem is that the banks are so big and complicated, and the regulatory agencies are so puny by comparison, that can't attract top people, because the salaries in the private sector are far better if you know anything about banking or risk management. So the regulators inevitably and institutionally are always on the back foot. I know it sounds defeatist, but that's the reality, and it's still a reality. So we call it in Chapter 10 the game of regulatory catch-up. It's a losing game. And we're still in the smouldering wreckage of what's happened. You know, the next boom will come. You know, it might be 5 or 10 years, it'll come. The lessons of this will start to fade in people's memories somewhat. So the only way you can deal with the situation really is to bite the bullet and say the government has to say, we don't want a massive financial system, because basically a lot of it's this casino stuff. It's not productive. One of the key regulators in the UK, Adair Turner, actually said publicly in 2009 that he thought most of what the City of London did was socially useless. And it is. Ideally, what the model is Australia and Canada. We have a financial system that backs the real economy, that provides loans to mortgagees and businesses. That's what kind of a financial system should do. It should be quite simple. It's just assessing risk on projects and lending. Now, if you want a big, what we call big finance, most of that's going to be casino-like activity driven by these immense competitive pressures to make huge amounts of money. If you had that system as a structural kind of feature of the economy, which the advanced economies have, you will inevitably run into this problem. It's really, really obvious problem. And the problem is that governments in the US and UK, and you can imagine you're David Cameron, and you wake up one morning and think, oh, okay, what I'm going to do tomorrow is shut down the City of London, essentially, you know? And you could say, okay, we're going to have capital levels at 50%, you know? We're going to absolutely separate investment and commercial banking. We're not going to bail out any kind of investment banking or anything like that. We're going to be draconian. And if you did that, you might over time wind back the casino and the whole investment banking culture and the whole rest of it. But it would take a lot of effort, and you'd get... These people are so powerful and so well connected. It's very difficult to take them on. So no single party has probably got the guts, frankly. That's the problem. That's the problem.
I've actually got two questions. The first one is, what actually happened to all those toxic assets that you told us about, the subprime mortgages and so forth? I mean, are they still lurking in the system somewhere, or have they all gone away?
Some of them are sitting.
And the second question, while I've got the microphone here, is our government at the time of the global financial crisis told us that because of the actions they took at that time, we emerged fairly unscathed from the problem. But from what you've been telling us tonight about the difference between our banking system and the American and UK banking system, I'm thinking, well, would we have been okay anyway? I wonder if you could comment on whether what the government did at that time actually was effective.
Okay. The so-called toxic assets, basically the market for RMBS, for instance, collapsed. Some of those assets still sit on bank balance sheets. Some got sold off. Some got bought off by government. So governments were actually buying some of these securities to try and help the balance sheets and positions of banks. At the moment, that market is dead. There's no esoteric trading in mortgages at the moment. The second one, two big things the Australian government did. One was to guarantee wholesale debt for the banks, which was really important. And fairly simple and fairly riskless. It was just simply the wholesale funding markets went into complete and utter panic and froze. No one was going to lend to other counterparties without a clear view of their balance sheets, and you couldn't get a clear view of their balance sheets. So that debt guarantee was really important. The other one was the stimulus package, which was a good idea too. And you can debate whether there should have been pink bats or whatever. or the level or the length, but broadly speaking, most informed commentators and some of the big agencies like the IMF looked at the bailout packages around the world, because most countries did it, and the Australian one wasn't a bad idea. Basically to help support confidence in the economy.
Thank you. One last question? Yes.
Yeah, thanks. I just wondered if you could entertain us briefly by speculating as to what might have happened had the federal government bailed out Lehman Brothers instead of letting it go. Because I've heard that as a big swing.
I think Lehman Brothers was kind of a shock, and it was a kind of a catalyst to further panic. If the government had bailed out Lehman Brothers, I think more or less the same thing would have happened, in the sense that the problem was really, really systemic, in the sense that lending froze across the entire system, and it wasn't just the government didn't bail out one bank. It was bankers and the wholesale credit market saying, we don't want to lend to anyone because we don't know what's on their balance sheet. The problem was opacity and complexity of the system that was created, and the uncertainty about if you're going to lend money, because big banks rely heavily on constant flows of debt and short-term lending. Often, I think Bear Stearns was relying on $70 billion a day of short-term lending. So when that flow stops or is curtailed, you're in big trouble quickly, and that was the problem. And that happened across the entire system for all players. So even strong banks, or relatively strong banks like Goldman, received bailout funds, etc., and were looking dodgy, and actually turned themselves into commercial banks and got out of the notionally got out of investment banking to get the cover of the state. They were running for cover too. So everyone was running for cover, and a lot collapsed along the way. The whole irony of this story in the Wall Street game was that everyone was trying to emulate Goldman, and they all failed miserably and died in the process. And Goldman comes through. So
I think perhaps on that note we ought to bring the proceedings to a close. I take it, though, you didn't, in the course of your research, keep a tally of suicides among bankers? There were a few.
Why would you commit suicide when you can walk away with $161 million?
Anyway, Steve, I'm fairly confident that the royalties will start rolling in once Harvard has thought this out. And there's no doubt the interested audience won't be confined to the United States. And you were very sensible to cover the 4 countries in your comparative study. I'm looking forward to reading it. I've heard a little bit about the background to it from a seminar you gave a couple of years ago. There's very much more to be learnt. And I'm really quite chuffed that a political scientist could be venturing into this territory and doing such a great job. Would you join me, ladies and gentlemen, in thanking you? Thank you, ladies and gentlemen. On your way out, if there are any who would like to take a membership form for the Institute, there are forms here. And also take one of the